What's up guys, Kieran here and you're very welcome to the channel. In this video I want to talk about these things and not drills. I want to talk about batteries, the thing that power the drills. And I don't want to talk about these old nickel cadmium yokes. I want to talk about these new lithium-ion batteries, arguably the powertrain of the next decade. And specifically, I want to talk about investing in lithium producers as a way of getting exposure to the growing demand for lithium-ion batteries. First, I'm going to take a look at the expected growth in lithium-ion battery consumption. Then I'm going to give a quick overview of lithium, the chemical, and where it comes from. Then I'm going to look at 3 different lithium producers. And finally, I'm going to give you my opinion on which one I think is the best investment and if I'll be investing or not. Before I get into it though guys, I'd really appreciate it if you give the video an early thumbs up, and if you haven't yet, consider subscribing to the channel. The aim of this channel is to bring you actually good investment content so you can make better informed investing decisions. If that's something that you're interested in, then stick around. Okay, so with that being said, let's get straight into it. We have a lot to cover today. Okay, so according to an analysis by Bloomberg, in early 2019, there were 316 gigawatt hours of global lithium cell manufacturing capacity, and they expect this to grow to 2,000 gigawatt hours by 2030. Now, to put a bit of context on this number, a gigawatt hour is 1 million kilowatt hours of electricity, and that's enough to power a third of the UK's chemical industry for an hour, or around 1 million homes for an hour. So 2,000 gigawatt hours would power 2 billion homes for an hour. So a lot of bloody energy. Now if we look at where Bloomberg expect this to go, we can see that the vast majority of this capacity is expected to come online to fuel passenger electric vehicles. Now I recently watched a great podcast by Hyperchange where he interviewed a guy called Vivas. And Vivas works for a company called Benchmark Mineral Intelligence. And in the podcast they went into really great detail on the lithium-ion supply chain. Now if you're interested in absolutely nerding out on this kind of information, then I'll leave a link in the description down below. But anyway, Viva said that they expect battery capacity to grow to 2,500 gigawatt hours by 2030. So considerably more than what Bloomberg expect. You can see in this graph that Vivas has basically shown all the capacity that's expected to come online over the next 10 years based on announcements that battery producers have currently made. So these are current figures. And from today it represents a continuous annual growth rate of 21%. However, if you look at the majority of EV adoption forecasts, they're continuously increasing. The majority of these forecasts indicate that we're going to go from about 3% EV adoption today to about 40% by 2030. Now personally, I think these forecasts are drastically underestimating how quickly we're going to adopt electric vehicles. The legendary S-curve, you've all seen it. Another thing that Vivas highlights in his interview that's very important, and you'll see this in the Bloomberg chart as well, is a lack of forecasted demand for energy storage solutions. I mean, if we're going to adopt renewable sources of energy, we're going to need a mechanism to store that. Now, we might end up using hydrogen, but I suspect a lot of it's going to be from lithium-ion batteries. Now, where is this demand? You don't see it in the graphs. Personally, I think that as the cost curve continues to decline for lithium-ion batteries, we're going to see forecasters increasingly up their demand forecast over the next 5 to 10 years. And what does all this mean? Well, ultimately it means huge increased demand for the materials that are used to make lithium-ion batteries. Now if we look at the raw materials that make up the battery, we can see that it's mostly nickel, lithium, cobalt and manganese. The content of each battery changes depending on the chosen battery chemistry. Some are using more nickel than others, such as Tesla's battery, which uses about 8 times the nickel compared to the Chevy Bolt for instance. Some then are using manganese, whereas others are using aluminium. The content has changed over time, as well as lithium-ion battery technology has improved. Now we already saw huge price surges in lithium back in 2018, when investors were speculating on the growing EV demand. However, as is common with most commodities, the price boom led to increased capital expenditures, which brought more supply online than was needed, and ultimately the price collapsed again after. Then the pandemic hit and further crushed any demand prospects for lithium. Things have settled a little bit since, and now lithium prices have stabilised. But we're still not far from the bottom, so that means now is a good time to start thinking about investing in lithium producers. Add to that the upside I expect in EV adoption forecasts over the next 2 to 3 years, and we could be looking at a good little investment case here. Now you might be thinking, why lithium? Why not nickel or manganese or aluminium? Well, out of all the metals used in lithium-ion batteries, I actually find lithium to be the most compelling case for an investment. It seems that all the others could essentially be substituted if push came to shove. Cobalt has seen similar price swings, and there is the potential for a supply shortage in the future. However, Tesla have come out and said that they want to go cobalt free in the future due to the human rights issues associated with mining it. So that's why I see demand for this metal as potentially risky, and why I don't see it as a good investment case. Manganese then, well, simply it's not used in all batteries, so I don't see the investment case here. Now when it comes to nickel, I'm actually already invested in a nickel miner, because I do think nickel is a good standalone investment. However, the nickel market is already massive at 20 billion, as nickel is heavily used in the steel industry. So for the purposes of getting exposure to the growth in lithium-ion batteries, I think lithium is a better play. It has a tiny market in comparison to nickel, so therefore the upside potential is greater. Lithium is found in 2 types of deposits today, brine and rock. A significant amount of the world's lithium reserves are found in concentrated deposits of brine, or salty water containing various minerals. An estimated 54% of the planet's brine deposits are held within South America's Lithium Triangle, which touches parts of Argentina, Bolivia and Chile. Other major lithium brine deposits are found in the Middle East and the United States, specifically in Nevada. The quality and composition of brine resources varies greatly, although the highest quality reserves are found located in the Lithium Triangle. Mineral rock deposits are the other major source of lithium compounds. The most sought after mineral is spodumene, which has been found to contain up to 7.7% lithium oxide content by weight. And major spodumene deposits are found in Australia, Brazil, Canada and China. Now producers are increasingly favouring lithium, which comes from rock over brine, for a number of reasons. Firstly, they're present in a wide variety of geologies and geographies. Australia has the world's largest identified spodumene reserves and offers favourable regulations to mining and extraction industries. The country is also close to China, which is the world's largest lithium market. This helps explain why out of 9 of the largest lithium projects in development today, Australia is home to 5 of them. And rock deposits are increasingly more suited to battery grade lithium. They're also easier to bring to market and they have more predictable production profiles. Whether sourced from brine or rock deposits, raw lithium is purified and processed into 2 main lithium compounds and a group of specialty lithium compounds. You have lithium carbonate and lithium hydroxide, and these are the 2 primary lithium materials traded on markets today. Each compound is listed at a unique selling price in regional markets. And lithium hydroxide typically trades at a premium to lithium carbonate due to its preferential use as a battery grade material. Lithium hydroxide is expected to rise from just 22% of global production in 2019 to 51% of global production in 2025. Okay, so now that you know absolutely everything to do with lithium, let's get into the investment case. Now obviously the best way to get exposure to lithium is by investing in lithium producers. So for this video, I'm going to talk about 3 of them. I'm going to talk about Albemarle, the world's largest lithium producer by base plate capacity, which is basically a measure of how much lithium they can produce. I want to talk about SQM, and I want to talk about Livent. All these 3 companies trade on the New York Stock Exchange, so they're easy to invest in. Okay guys, so let's take a look at Albemarle first, supposedly the world's largest lithium producer. Now if you look at this slide, you can see that 37% of their total revenue comes from lithium, 29% comes from catalysts, and 28% comes from bromine specialities. Now these other specialty chemicals are used in fire extinguishers and refineries. Now Albemarle has lithium projects in Chile, Australia and Argentina, so they're quite globally diversified. If we look at the stock, you can see that it's currently trading at about $87, down quite significantly from its high of $140 at the end of 2017. The company has a market cap of 9.3 billion and is currently trading for a PE ratio of 18.3. Livent then, as I said, is a pure lithium play, and it's a much smaller company with about 5% global market share. Now Livent was actually spun out of FMC in October of 2018 and traded at a price of roughly $18 during the high. Now it's currently trading at about $7, so significantly down from its high. It has a market cap of about 1 billion and a P ratio of 33, so a little bit more expensive off the bat than Albemarle. Now you can see Livent produced about 443 million in revenue in 2018, and 87% of their revenue comes from lithium. So as I said, it's a pure lithium play. The other producer then we're going to look at is SQM. Now SQM produces lithium, specialty plant nutrition, iodine, potassium and industrial chemicals, but about 50% of its gross profit comes from lithium. And they are ranked the number 3 global lithium producer in the world with a 14% market share. And they've got projects in Chile and Australia. I didn't mention it, but Livent is not very diversified when it comes to its lithium production projects. And while it does have chemical production plants scattered around the world, its lithium production comes primarily from Argentina. If we look at SQM then, the story really repeats itself. From a high of about $60 at the end of 2017, they're now trading for $30. So all these stocks are pretty beat up. And SQM has a market cap of 7.9 billion and is currently trading for a P of 32. Let's head over now to this Excel sheet that I created and let's do a comparison of the companies. So again, if we look at market cap here, we can see that Livent is trading for about $1 billion, Albemarle 9.4 and SQM about 7.8. So Livent is a much smaller company, Albemarle being the biggest company and then SQM behind that. If we look at their 52-week highs, we can see that they're all trading down significantly from those highs, but Livent is trading down the most at 44%. Albemarle is down just 11% and SQM just 10%. In terms of revenue then, so Livent produced about 400 million in revenue. Now this is trading 12 months. Albemarle 3.5 billion and SQM 1.8 billion. In terms of net income then, Livent produced about 31 million, Albemarle 506 million and SQM 242 million. Now let's take a look at the balance sheets. And from here I'm going to start rating the companies in comparison to each other. I obviously don't do this in terms of revenue or stock price because that's all relevant to the size of the company. But if we look at the balance sheet, we can see that Livent have 11.4 million in total cash, Albemarle have 553 million and SQM have 1.35 billion. Total current assets, Livent have 239 million, Albemarle have 2.15 billion and SQM 3 billion. And if we look at the current ratio, which takes the total current assets and divides it by the total current liabilities, and it's a really good measure of if these companies stop producing tomorrow, how long would they be able to service their current liabilities for? And for Livent, this is a number of 3, Albemarle it's 1.8 and with SQM it's 3.24. Now a number above 1 here is good and anything above doesn't give any red flags, but we can see that SQM has the best current ratio, Livent in second and Albemarle in 1. So based on their balance sheets, I scored SQM 3, Livent number 2 and Albemarle 1. Now I should say that the higher the number here, the better. So 3 is my number 1 pick, Livent is number 2 and Albemarle is my last pick at number 1. The reason I'm scoring them based on the higher number is because I'm going to multiply the numbers at the end, so the higher number gives a better score. If we look at the valuation metrics then, we can see that Livent has a P of 32, Albemarle 18 and SQM 32 as well. Price to sales then, 2.76 for Livent, 2.6 for Albemarle and 4.3 for SQM. I have the price to book out here as well and the price to cash flow. And based on all these metrics, I scored Albemarle in first place here, I gave it a 3. I gave Livent second place and I gave SQM a 1 and put them in the lowest place. In terms of growth then, we can see negative growth for Livent and SQM, and Albemarle then is the only company showing a year over year positive growth. We also have positive 3 and 5 year growth rates for Albemarle. For SQM they're negative and for Livent we don't have any because they're only in existence since the end of 2017. Based on these numbers, I put Albemarle in first place, SQM in second and Livent last. If we look at profitability then, we can see gross margins for Livent 27%, 35% and 28.5% for SQM. Livent then has the lowest net income margin of 8.7%. SQM then is at 13.24% and Albemarle is in top place at 14.5%. Based on these figures then and the figures below, I put Albemarle in first place, giving them a 3, SQM in second then and Livent last. The last thing I rated them against then is dividend. We can see that Albemarle and SQM both pay a dividend, and while SQM pays a higher dividend, Albemarle has 26 years of dividend growth, whereas SQM has only 1. So based on the consistency of this dividend payout, I had to put Albemarle in first place, giving them a 3, SQM a 2, and then Livent don't pay any dividend, so I gave them a 1. If we add up the scores then in each section for each company, we see that Livent gets a 7, Albemarle gets a 13, and SQM gets a 10. So based on this, I put Albemarle in first place as the leader when I assess these companies based purely on a quantitative, fundamental financial analysis. Okay, so provided the lithium-ion battery demand continues to grow, we can expect demand for lithium to grow as well. However, at current prices, few producers are making the much needed investments to secure future supply. And if we see an upside to battery demand in the future, this ultimately could lead to an undersupply and a surge in lithium prices. My base case for this investment is that despite what the analysts say, the lithium producers find a way to keep up with the growing demand. As a result, prices for lithium remain steady. In this instance, I'm simply investing in the growing demand from these producers, and I'll enjoy the top and bottom line growth associated with that. In my bull case then, we see that demand outstrips supply in the coming years, and we see a huge supply gap and a huge increase in lithium prices like we did back in 2018. With this, valuations for these lithium producers goes sky high. If this happens and we do see valuations go sky high, then I'll be selling in the exuberance and waiting for an opportunity to get back in at more reasonable prices. Based on my review of the company's fundamentals, I think that Albemarle offers the best investment case. Based on my rating, it's a better buy than the other two, and its valuation is also more appealing. It also has its legacy business, which stabilizes the business to lithium price swings. This de-risks the business during low lithium prices, but it also limits the upside during high lithium prices. So it's for that reason, if you are a real believer in a huge surge for lithium demand and an increase in price, then Livent is the only pure lithium play here and potentially offers the most upside in that situation. But as I said, it also comes with more risk. You could of course just diversify into all three of these as well. Or maybe there's other lithium producers that I didn't review. Okay, so what am I going to be doing? Well, I think I'm going to make a small investment into Livent and Albemarle. I'm not going to be maxing out my portfolio with these positions though. While I think they're good companies and they do have a good risk-return profile, I think there's probably better opportunities out there in the market today. For instance, I'm probably more bullish on gold and silver miners, just with everything that's going on in the economy at the moment. But if you're interested in this space, then there's nothing wrong with these companies, and I think you'll probably do okay investing in them at today's prices. Okay guys, I hope you got value from this video. If you did, please consider giving me a like, it really helps the channel. And if you haven't yet, then consider subscribing to the channel and turning on the notification bell. As I said, I'm all about bringing you actually useful investment content that you can use to make better investment decisions and ultimately see better returns over the long term. I'm not a financial advisor, I'm just some guy on YouTube, but hey, the more information you can get to make your own decisions, the better. With all that being said, thanks so much for watching, and I'll see you in the next video.